All right, my beautiful people. I hope you're having a wonderful Saturday. I got Jax here in the background, so you're not going to hear him being annoying, but you might hear a squeak or two, so forgive me. But you guys gave me, you gave me the feedback on these. I got another video. I want to talk about it. We're going to talk option pricing probability and the probability of you guys making money day trading. And I think this is an important topic for options. And honestly, in my own research of doing this, I got to learn about something I didn't know. So especially with Tastyworks, like probability of profit and your Thinkorswim, you could get probabilities. I'll show you guys how to pull this up, but they're different. And if this is something I just learned, I think it'd be something to clarify for all of you. Now, I want to talk about option pricing, break even on options, and what is the last part? Probability of profit. It's the same thing, really. So that's what we're going to talk about. And I got this idea because I saw Oliver. You had your man. Okay, Jax, come in. You had. Okay, hold on. Okay, I'm going to try it with Jax in the background anyways. You're going to get a little, you just threw me off there, but I feel bad. I can't kick him out the training. But it's Oliver, your boy commented on there, and you guys were talking about another trading, account on YouTube. And I looked at a video and it referenced probabilities, and I was actually shocked at what I saw because it was something I think that could get clarified. I think a lot of people misinterpret this, and a lot of new traders are not aware of how it works, even a lot of familiar traders. So we're going to talk about that. Guys, as always, we're going to be streaming every day that the market is open, Monday through Friday. So make sure you guys do not miss that. So let's get into it. Option probability and break evens explained. I don't know why I literally have a new chair. I don't know why this one's squeaking. So I'm gonna get back up. There you go. So this is one of the most simple but overlooked understandings in my opinion, because most of you get it intuitively. However, a lot of people fail to understand the options application when we start looking at break even. So break even is a term that comes up on every option. When you buy an option, it has a break even price. And a lot of people don't really understand how this works. And what I mean by that is that they're like, oh yeah, break even, but the implications this has on you understanding options is making money. It's very, very important. So what I want to go through is to make sure that you guys are really understanding how this is going to affect your trade. So we're going to talk about I'm going to go over what break even is for the beginners very, very easily and quickly. And then we're going to get into what I want to talk about here. So, and then this is for all of you. Understand how break even and probability of profit, or POP, this is what you see on Tastyworks. One, they're different. Probability of profit, and here, probability in the money, or your break even. You see there's many probabilities, and this is how you go to it on Thinkorswim. One, you change the layout through here, right? So you could go to implied volatility, probability, all that. Click this, options, theoreticals, and Greeks, and then for the basis of what I'm looking at, we care about probability in the money because getting in the money is the closest thing to break even, and how it's traditionally used. So this is what I wanted to say. The number one thing people miss is that probability of profit and break even price, it's all based upon the price at expiration date. So the probability of your option being profitable, it's based upon expiration. So a lot of people think, okay, this option has a 30% probability that I'm going to make money. No, that's not what it's saying. It's saying there's a 30% probability that it will go past your strike price and the price you paid. So this is that thing I saw in that YouTube video where I was like, whoa. I can't believe people are actually looking at it like that, because they think, and that's where I learned here through Thinkorswim, you could do probability of touching, probability of out the money. And this is where I don't like Thinkorswim, because they start to give you so much data that's confusing. So traditionally, the closest thing to break even is probability out the money, probability in the money. See, it gets confusing because that is where break even is trying to explain. Break even is saying at expiration date, you will make or lose money if it's at this price. So this is now for the beginners. This is how break even works. Think about it as a business. I buy Yeezys for $100 and I want to flip them. In order for me to not lose money, I just have to sell those shoes for at least $100. That's my break-even price, right? If they aren't selling for more and I only get $100, I literally break even. That means I don't lose or I don't profit. That's the same thing with options. So when you hear break even, that is saying, well, this is the event that I don't make money. Now, here's the confusing part, because people are like, why does that matter, Josh? I want to make money. Why would they? Well, why would a whole industry of options be based, like, why is the whole community in the financial industry based around explaining this whole break-even concept? Why don't they say how much to make money? Like, literally, why don't they do probability of profit? Because this is a derivative contract. It's letting you know, because people bought these a lot of times. You could imagine buying an insurance policy where you didn't lose money and you got to insure your asset and you got all of your premium back. You'd be ecstatic. Well, imagine if I gave you all of your car insurance back if you didn't get in a car accident. It'd be free. So that's how options are originally designed, my friends. We're just trading them like degenerates. We're literally trading insurance policies for profit. So that's why you break even. And if any of you are familiar in the insurance policy or annuities, this concept of break even, and it comes up a lot. But also just like business. So what I get now, let's say I get $120 for those shoes. I now profit $20. But I know now if I'm not going to get $100, I say, what is the probability of the Yeezys going to $100? If they're not going to get above $100, that means the probability of me losing money is high. I'm going to guaranteed lose money instead of not lose money, right? So, but you get $20 profit. 120, you profit 20. So it's pretty simple. So what I'm saying is bring break even back to the option change. This is what you guys are doing on the simplest scale, but this is for all of you now. You are running an option trading business. You are literally holding inventory that has different break even prices. You're buying stuff with certain break even. Sell it. If you don't get what you paid back for the item, that's it. Now, the best part about your inventory, you guys are in a different business. Your option contracts are literally like bread and milk. They expire really, really fast. So you have a break-even date. You have a how much you paid for your inventory, and then you have an expiration date. So if you don't sell your bread or your milk by this time, and now it's saying if you bought, this is how we're using literally bread and milk, you guys. Isn't this? This is a beautiful option example, but it's so applicable because I think all of you could understand how fast and worthless expired milk becomes. They don't even sell it at stores, or bread, hardened bread, moldy bread, right? So that's literally what is going on here. So if you say I'm paying $500 for bread that expires tomorrow, it's pretty much saying you need to be able, the price of that bread needs to go to whatever price you're agreeing to buy it at, $5 a loaf plus $500 over for you to make your money back. So this is the whole point of what I'm talking about, because break even is literally the reason why both you and I could buy the exact same option and you can lose while I make a profit, or other way around, right? A lot of times, that's why I laugh. And someone even commented, they're like, how do we know this is not some scheme for you to front load everybody or to take advantage of this and get ahead of everybody? I'm like, dude, you guys front load me on some of the options. and that's the whole, that's why I say some of you guys could wait, because if I overpay, you could get in at a cheaper price, and vice versa. Some of you guys jump in early. Oh, well, I might get it early. I might get it later, because options is so volatile. You can't even front run. What am I going to front run here? Because it is so volatile and changing. And there's a lot more billions of dollars that are making pushes, and it's a derivative. It's based upon the underlying stock. So at the same time, though, if you guys are, this whole concept of break even, we could buy the exact same loaf of bread. And we could buy it at the exact same price. Like, hey, I'm buying this loaf of bread with the agreeing to buy it for $5. That's a $5 call on bread, right? And it's going to, when the bread's going to expire. But if I paid $100 for that $5 call and you paid $200, well, the bread could go to $6 and I will break even and you will lose $100. And vice versa. If it goes to $700, I'll make $100 and you'll break even. But we literally bought the exact same thing. However, the price I paid to secure my bread versus yours is different. And that's what break even is you're paying this money to secure it. And now this is why it's so important, because a lot of you guys, it's the same reason why I could look at an option chain, just like those Amazon weeklies, and be like, you guys ask me, how do you know if it's a good price? Understand break even. If I see an Amazon contract and it's like, yeah, Amazon in the next hour has to go $100 and I'm going to pay $300 for that? No way, get out of here. You see, because that's just not likely. That's where this is what I was saying. If you're paying attention, you just got to be smarter than one guy and be smarter in that case. So this is another extreme point on the importance of timing, because you see, we buy one thing at one time or the other. The guy who buys it at the right time can buy the exact same option. If you know how to, you could find out what I'm playing. Like, go look at those IWMs. I gave that out to you guys, not so you could follow. I'm giving you guys this stuff not so you copy me, but so you learn. Because guess what? You guys will probably be able to find better prices on the exact same play ideas, and hopefully you let a brother know. You know what I'm saying? Help me out too. But that is the whole kind of concept here. But it's a very free, beautiful game because you can kind of get the idea, and everybody could have the idea. But the one with the good timing and the one who's understanding these concepts, they're going to make the most money. So all of us could buy the same thing, but each one of us is going to make a different amount of money. And isn't that crazy? That's what it's beautiful, right? That's life. We could all be given the same thing, but how are you going to use it? And what did you give up to get it? So the true snipers, they're the ones who get it at a low break even. So they buy it at a low premium, because then that's why options go crazy. When I buy the 10, 20, 30, 40, 50 cent options, I'm buying them at low premium. So therefore the break even is very, very low. When I'm buying a 30-cent Amazon, my break even is only adding 30 cents at the break even. So when it goes up and up and up, that's the thing. As the stock and expectations go up, now the premium and break evens do. So I could have the same Amazon with a 30-cent break even, and you could be paying 300 for that same one because now it changes, right? So it can make a play, and probabilities just literally are completely different, and it could always be changing. And that's now the Greeks, just like the Greeks, right? Just like delta, theta, vega, all that stuff. Break even and probability of profit are not static. They are constantly changing. A lot of people don't realize this. Your delta changes. You could buy it at one point in one time with a certain delta theta. However, as implied volatility change, as everything in the price of the stock changes, that goes with it. Once you purchase a stock, so break evens are always changing. That's why an option at this price is going to have a different break even than at a different time. But once you purchase your contract, your break even is locked in. So the minute you spend $1 for a $100 contract, your break even is 101. You need to make $100, and that is the concept. Hopefully you guys get, where you make the money back through the shares. Because if you get in the money on a contract, every $1 will produce you $100 of profit because you have the right to 100 shares. So if I'm saying you bought a $100 call for $1 or $100, simply for you to make that $100 back, the stock has to go $1 above. And now people are saying, why? Let me give you, I forgot to write this down, so let me put this here. Because at expiration, or if you exercise, look at my awful spelling, your money is gone. So when you buy a contract, the minute you give it to the guy with the premium, right? I'm collecting it. The minute you buy it, the guy who sold it, me or anybody else who's selling premium, they collect it. And then what happens? You paid for it. So if you exercise it, the money's gone. You just have to make sure the underlying value of the contract is worth more. That's why break even now is also so important. So if it expires worthless, you lose the money and that's it. But let's say you expire in the money, but it's not at your break even, you would say don't exercise to your broker because you would lose. But the minute you exercise, your money's gone. When you buy an option, it is a sunk cost. So just like you're running your business, the cost of the contract, the inventory, the minute you spend it, it's down the drain. So unless you sell it back before expiration, at expiration, or if you exercise, that money's completely gone now. So the underlying asset has to net you back more money in profit. Excuse me. So, like I said, probability is locked in once you buy it. However, 30 seconds later, that could change. So if you buy it, once you buy it, your break even's locked in. But if somebody comes in and buys it and the option drops 50%, they're going to have a different break even. But there you go, because if the stock drops, their break even, their delta, theta, all that just changed too. So that's something really, really important to note, that this stuff is not static. It is not. It's dynamic and it changes a lot. So, and again, that's why sometimes I'm not a big fan of the Greeks. If you've watched my videos, we'll talk about that. It's kind of related to the ghetto spreads, and also if you're waiting for the ghetto spreads, just hold up, man. You guys are You guys are going crazy. He's like food stamps. But lastly, I don't know why I skipped to number 5 without a number 4, but that should just show you, be careful of trusting people on the internet about finances, including myself, because most of the people on YouTube, including me, are pretty retarded. So you guys should do your own research. Option probability is based in a degree off of past performance. The Black-Scholes model. Well, the Black-Scholes model is calculus, and I suck at math. I still count on my fingers. But there is ways to take advantage of it or where it's flawed. However, to say you're smarter than that system, I don't say I'm smarter than it. However, I just know, what I go for. The most academic way to explain my approach is that all markets have inefficiencies. And I look for market inefficiencies. So when you guys are asking me, you can't find mispriced options. To say, I do believe these markets run efficient most of the time. However, there are market inefficiencies and there are imbalances in supply and demand and all that stuff at times, which lead to windows of opportunity. So this is what I want you guys to understand, that the Black-Scholes model and how they're coming up with these probabilities, that's what gives the price of an option, which, so think about it. The Black-Scholes model is coming up with this price here, which is in effect saying, this is why they expect it. And how did that get generated? This price is based on the past performance of the stock. So if a stock over the last 300, it's literally like square root 365 or something, literally for the last 5 days, 365 days, it's moved 1% with this outlier. Like literally, it's a crazy formula, but it's saying statistically this is what's going to happen or most likely. So the statistics of it, the probability is just letting you know, based on the past, the odds of it moving are this. That's why when a contract is priced cheap, it's not that it's a good deal and we're scamming the market. It just means the market's telling you historically and based off of this mathematical function, the odds of this are very, very low because that's just never going to happen. If you took it and plotted it on a scale 1,000 times in a row, the chances of what you're saying is going to happen 2 out of every 100 instances. So that's where it says, it's based on what's happened in the past, which is how you get future expectations. But I'm going to talk about anything could happen. However, you have to understand probability is mutually exclusive, meaning it doesn't change based on what happens. So even if the stock market drops or corrects for 5 days, a week, that doesn't change the probability of stocks crashing or puts or calls going down because it's temporary, unless there is a historical down, 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 up, down, 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 down. You know what I'm saying? But it's a coin toss. So what I'm trying to say now, if I took a quarter and I flipped it and it's heads, that was a 50-50. I flip it again, heads, heads, heads. I do it 9 times and it's all 9 times in a row. I'm flipping a coin, heads or tails, and 9 out of 10 times, my first 9 times it hits heads. Is the probability of tails increased on the 10th one? Think about that. Answer below. I want to know what you guys think. I won't, answer. I want to know. We'll come back to it at the end and you'll see if you were right or not. And give me your analysis on this. Don't just say yes or no, explain it to me. If you say yes, explain why. If you say no, explain why. Or how would you take advantage of it? If you came to a guy on the street, it's not a double-sided coin. He flips 9 heads in a row, and you could bet on the 10th one. How many of you are betting tails? How many of you are betting heads? But pretty much, as you see here, options and some of the plays with inefficiencies, anything could happen. That's why you never know. So if you're selling premium, you could still get your shit blown up because these aren't always safe. And like I'm saying, this probability could change. The probability here, go watch my portfolio during the day. You'll notice that these probabilities change. Like this Boeing, this will go to 40% probability to 80 in one day. It's always changing and always fluctuating. So anything could happen. And this is why I'm making this video. Don't trust statistics too much. I love the statistics, but what I'm trying to make sure you guys are balanced where you're not following these probabilities too much. However, it's understanding statistics. That's what I really want you guys to say. I'm not saying don't trust it, but understand when it works in your favor, when it doesn't, or how to literally just interpret it so you guys are making the wisest, smartest decisions. So give me your feedback on that. And this is what I was going to show you. Here's the probability of profit on this Facebook. it's 23%. And this is now what I learned is that Pop is saying, okay, what this is saying probability of profit. So it's saying, what are the chances I go past break even and make money? So in this case, if you bought a 170 Facebook and we bought it at the ask for $170, our break even is 170. So by February 15th is what it's saying. And that's what the probability of profit saying, is that by February 15th, the chances of you making $170 and even more, so $171 is making $1 profit, is about 23%. So you go here, this one's saying it's 30% on the same 170. And this is where I said is you guys got to be careful, because look at, you go on every platform, you'll find whatever information to confirm whatever you want, right? I could get whatever, I can make this probability look however I want. Because look, 30% here, it's 7% different, but now this is saying probability of just getting in the money, but not necessarily, not necessarily profiting. But all of everything though, when you do look at these metrics, it's based upon expiration. It's not saying 30% in the money tomorrow, 30% in the money today. It's saying by expiration. So it's like it's like a mortgage rate. When I say, yeah, you're paying 4%, annualized, or, you're not paying 4% every single month. It's spread out between 12 months, that 4%, right? So again, this is where you guys, the world of stock markets is filled with confirmation. Look at now, out the money, 69. I could use whatever stats really to justify almost any strategy I want. A probability of touching, boom, here's my day trader. Okay, oh wow, 60%. Oh, 80%. Wow, there's an 8 and 10 cents. I'll have a good talk. You know what I'm saying? So you got to be careful on that, because these change. It's 82% now when the shit's not moving. So think about that for a sec. But I will leave you guys there. Hopefully you guys enjoyed this. Make sure you subscribe. Drop a like if it was helpful. You guys dropped a bunch of comments on the last one. Again, it motivated me a lot. Let me know what else you guys want the ghetto spreads video. I want to make that one really, really good. And it is with selling premium. So there's a lot of advanced concepts. So give me time with it. But I'd rather, honestly, I'm going to be doing those live. I've been doing those live. If you want more insight, go watch some of the past selling premium videos. If you watch any of the videos I've made, I even have one, how to literally in the description here, how to make the premium, or how to start trading with the small account. You could see where this Tastyworks account was. It's grinding up, but I've done every single trade here. Here is the account history. I think I'll upload this in another one, and we'll go from there. And like I said too, you guys, this is Tastyworks. We have a referral link in the bio if you want to use it, but I found a way to explain it more to people, where if you want to use Tastyworks and all that, I think if you're trading with less than $2,000, go to Robinhood. If you have more than $2,000, go to Tastyworks. If you want to use my referral link, be my guest. I would still recommend the same thing to you. Just go to tastyworks.com and don't put in my code, and you could do the same exact thing. If you could get if you could get the $1 or cheap commissions from TOS, do it. But this is why I never use TOS. And you guys see where I love how this is why I say it's so powerful. But for a guy like me who's not technical, and I told you I'm not the brightest light bulb in the room, I'm not a fan of this. This is just too much for me. So that's why I got my E-Trade or my Tastyworks. So I will leave it there. I love you guys. Let me know your feedback, and have a good weekend. Be safe. Go Rams.